the participant, and he is a counterfeiter. There should be a picture on Time magazine with him flying a helicopter, pushing out money. Congressman, he's known for saying that he's helicopter Ben.
Aloha mai kako. You are watching Hawaii Political Reporter.
Hey everybody, this is Alex Merced from alexmerced.com, and this presentation is Federal Reserve 101 about the United States central banking. Okay, basically this video is just me to teach you guys a little bit about central banking. A lot of people are familiar with what the Federal Reserve does and understand things like that it increases the amount of money in the economy, it can decrease the amount of money in the economy, but all the ins and outs, let's go over them. I'll tell you the story of the Federal Reserve. In 1907, a guy by the name of Charles Morris tries to corner the Knickerbocker Trust Company, and corner the copper market. Okay, and as he corners the copper market, the trade goes bad and the Knickerbocker Trust Company falls. And just to kind of show you, a free market way that the market sort of handles these type of episodes when there's no central bank, well, who has the most to lose? Okay, the people who have the most to lose when the economy falls are the people with the most. Okay, if you don't have anything, you don't even notice that there was a recession because you're just as bad as you were before. So what happens is that JP Morgan had, and many other wealthy people had a choice. They could either watch the banking system fail and lose a lot of their wealth that's tied up in it. That a lot of it was gotten through rent seeking or basically lobbying government for grants for railroads and bank charters during the 1800s. Okay, and they can just watch it fall and lose all that money, or they can use their own money and support the system. And that's what they did. I guess you figured they would lose less money if they supported the system than they would have if they just let nothing happen. The problem is they weren't a big fan of doing that, so they lobbied for a central bank with the help of a Senator Aldrich, resulting in the Federal Reserve Act of 1913. Okay, and this created the Federal Reserve. Now, the Federal Reserve did not open its doors until 1914. Now, the Federal Reserve is the current existing central bank of the United States. Right now, it's 2012, so next year will be the 100th year of the Federal Reserve Act, and in 2014 will be the 100th year of the operation of the Federal Reserve. Okay, now, the several functions or purposes of the Federal Reserve Bank, as stated through different policy measures and laws that have been passed, are things like preventing banking panics. And it can do this through discount lending and providing money to banks when they're having a rough period of time. The idea isn't to bail out bad banks, but sometimes banks are, for the most part, solvent. They haven't done anything necessarily wrong per se. The problem is that maybe a counterparty falls apart for some sort of random, reason, especially during this period of time when like 70% of the population was agricultural. It was very easy to have like a bad crop yield, and that just causes one bank to have a problem, which then causes the next bank to have a problem. Although, if you take a look at this period of history, banking panics don't end. They actually continue even right through the Great Depression. Banking panics really don't stop until 1933 with the passing of the Glass-Steagall Act. Now, two things happened in 1933. The U.S. goes off the gold standard, and there's the establishment of the FDIC, Federal Deposit Insurance Corporation, in the Glass-Steagall Act. They supervise and regulate member banks. So not only do they set a lot of the requirements, like the reserve requirement I'll talk about later, but they also set like capital requirements for banks' investments, because banks don't only lend out their depositors' money. Banks generally have a lot of their own money that they do investment with on the side. And a lot of times they'll leverage that money. So the Federal Reserve and other banking regulators will set capital requirements saying, okay, well, if you're going to borrow this much money to make this investment, you need to make sure you have this much capital on the side. They conduct monetary policy. So the idea is the Federal Reserve is supposed to increase and decrease the amount of money in the economy to maintain full employment and stable prices. So the idea is, this is based off an idea that sort of doesn't necessarily really hold true most of the time, called the Phillips curve. The idea is that there's a trade-off between unemployment and inflation. So the idea is that when there's unemployment, the Fed will put money into the economy, and then once there's inflation, the Fed takes money out of the economy. Okay, because the idea is if people are unemployed, it's because money is not necessarily, that's not that there's enough money, but money's not moving around enough. So the Federal Reserve puts more money in, as you'll see later on, to lower interest rates, which will get people to move money around because people will make riskier decisions. So instead they'll spend instead of save. They'll buy higher yielding instruments or buy riskier investments instead of the safer investments. Okay, they'll take their cash and buy assets, expecting asset price increases. And the idea is that they'll get money moving around. It's not that the fact that there's more money that gets things going, but the fact that the increase in money gets people to choose not to hold their money any longer, that sort of get things going again. And suddenly employment rises, but then as employment rises and that money begins to spin around, that causes inflationary price increases and price inflation, and then that leads to problems, and the Fed takes the money out, and you see the opposite happen. The Fed is also supposed to manage systemic risks in the financial system, so through monetary policy and through banking regulation, they're supposed to try to prevent threats to the financial system. At the end of the day, the Federal Reserve's number one focus, they're the heart of the financial system. So they're really, at the end of the day, everything else is paramount to protecting the integrity of the financial system. Whether that needs more regulation or less regulation, whatever it takes to make sure that faith and strength of the U.S. financial system is there, that's what they'll do. Whether it's at the cost of other parts of the economy, whether it's at the cost of everything else. Okay, their number one goal is to make sure that the U.S. financial system is functioning. Now here's the structure of the Federal Reserve. Okay, you have the Board of Governors, which are 7 members appointed by the president. So basically the Board of Governors is really sort of an arm of the government. Okay, and they're confirmed by the Senate afterwards. Now again, the structure of the Federal Reserve, the idea is to create sort of interplay between the government, who's supposedly supposed to represent the public, and the member banks, who represent the financial system and the interests of the financial system. And the idea is you want to have people who represent the banks because you want a healthy banking system, and they're people who understand the banking system, but you want people who are appointed by the government because they're supposed to represent the public and the interests of the public. Okay, and again, just so you understand the intention here. Okay, so now let's talk more about the different policy tools and levers of the Federal Reserve. There's a reserve requirement. Every bank, okay, when it comes to its depositors, is supposed to put a certain amount of their depositors' money on the side. Okay, that's 10%. So you put in $1 at the bank, 10 cents are put to the side. The other 90 cents can be lent out. Okay. So basically, the bank has to keep 10 cents of your deposit on reserve, and before they can lend out the other 90 cents. Although if a bank lends out too much money, which is possible, okay, more than possible. So if they lent out every dollar, well, then they wouldn't be able to meet their requirement. But there's other banks that have more than enough extra, that didn't lend out all their money. They have extra money. That extra money they have above their 10% reserve requirement is called Fed funds. It's extra money they have at the Fed. And what they do is they sell it in this overnight market. Now the reason it's called an overnight market is because literally you need to meet that reserve requirement at the end of the day. So you only really need to have that money at the end of the banking day, you know, when they settle everything, to see who has what has who, whatnot. So at the end of the day, you go into that Fed funds market, and then you borrow the money you need from another bank just for the night. As soon as the banking day opens the next day, you give back the money and you pay like nothing for interest. Okay? And they do this every day. But sometimes so many banks lend so much money that there is nobody you can borrow money from because everybody's levered to the hilt. In that case, worst comes to worst, you can borrow money from the Federal Reserve, long as you can post up, again, quality collateral in the form of like T-bills, short-term government bonds. Okay? And you can borrow money at the discount rate. Okay? It's set by the Fed. Now, the thing about the discount rate is borrowing money at the discount rate is typically transparent in the sense that you can see it's public knowledge who borrows money at the discount rate, and typically the result is that if it's a publicly held bank, people will begin shorting that company's stock, which can hurt its capital requirements and become a real sort of self-fulfilling prophecy. So in that case, a lot of banks avoid borrowing at the discount window. That's why in 2008, it wasn't the Federal Reserve just opened up the discount window lending to everybody and told everyone to borrow money at the discount window, because the idea was if everyone borrowed money at the discount window, it's kind of like what Paulson did with TARP, made everyone take TARP. The idea is if everyone has to take help, then you don't know which is the bad bank. And if you don't know which is the bad bank, you don't know whose stock to short. Temporary open market operations. Again, this is what the Fed does on a daily basis, particularly at the New York Fed branch, is where all this is handled. And they don't, usually when they're putting money into the economy, they're not doing it by actually like putting money into the economy. What they do is they buy stuff. So, okay, so think about it. If I went to your favorite store and just bought everything, that store would have more money. And that's basically what they do. They go shopping. But they don't go shopping permanently. What they do is they do temporary open market operations, which means they enter contracts. So basically, if I'm the Federal Reserve, I'll enter a repo with you. So that means today I'm going to buy T-bills from you. Again, short-term government debt. I'm going to buy it from you today, and then you're going to promise me that 2-3 days from now, you're going to buy it back from me. Okay, thus it's called a repurchase agreement. So the Fed gives you money today, but you have to give it back 2-3 days later, maybe even up to 5 days later. Okay? And then that means you have extra money during that period of time. And if the Fed thinks you should still have that money afterwards, they'll just redo it. Okay? So this way the Fed can always kind of keep a very tight control over how much money is in the economy. And they would do the opposite, a reverse repo for the opposite. That means you would buy a treasury from the Fed, okay? And then they would buy it back from you a couple of days later if they were doing reverse repos. Okay? So, again, I see I have a typo here. The Fed will enter reverse repos when they want to remove money from the economy and raise interest rates. Okay? Think of basically the amount of money in the banking system in particularly. So again, for example, let's say the Fed did something differently. Let's say the Fed increased the money supply by using cash, and they use the cash to buy illegal products. Okay, as an example, this is just an extreme example to illustrate a point. Okay, well then those illegal purveyors of certain goods would not deposit the money in the banking system. Okay, so while there'd be money pushing up prices through consumption per se, you wouldn't necessarily see a change in interest rates because the banking system doesn't necessarily have more money at the banks. Again, banks will only lend you their prices for their money that you can borrow from the bank is based on how much money they have. So the Federal Reserve gives the banks more money, then interest rates change. And again, more money, lower price, meaning lower interest rates, and less money would mean higher interest rates. So the Federal Reserve will again tinker around with this as they see fit. Permanent open market operations. This is when the Federal Reserve just buys stuff outright, usually referred to as quantitative easing. Okay, when they're buying stuff. Generally, they only really do this if they're pulling out the big guns. Okay, so if you see the Fed just outright buying and selling stuff, usually means they're worried or they're serious. They're really trying to address something. Okay, they generally do everything temporarily, very short run. Okay, they're not one to try to be bold about these things. Operation Twist is a special policy that the Fed does where they sell the short-term debt, okay, and then they buy long-term debt. Generally, the idea here is to push down long-term interest rates, because the idea is if you buy long-term debt, then the price of long-term debt will rise, and then when bonds price increases, interest rates decrease, okay? And this helps keep mortgage rates down and all sorts of other long-term debts down, okay? Now, why did they do this? They would usually do this if there's a lot of demand for short-term debt. So, like, for example, right now, it's 2012, short-term rates are low, not just because the Fed's put money into the economy, they're actually taking money out of the short-term end of the yield curve or out of short-term bonds. And the reason they can do that is because out of all the fears with the European crisis and everything else going on in the world, the rest of the world is investing their money in the short-term U.S. debt. So in that case, the Federal Reserve doesn't necessarily really need to prop that up. They can work on propping up the long-term debt. Now, the thing about monetary policy is that it affects all the following things. It affects risk-taking. Okay, if interest rates are higher or yields are higher, okay, in that case, basically, you can invest money in fairly safe instruments and make a decent return if interest rates are higher, okay? So in that case, you're going to take less risk because you can get more without taking less risk. While if the Federal Reserve pushes interest rates down, well, that means you don't get that much for taking no risk, which forces you to take risk. You end up taking riskier behavior. So sometimes, again, the effect of the Federal Reserve lowering interest rates is not the fact that there's more money and everyone just decides to spend more money, but the effect is, since holding money doesn't, or buying, investing money safely doesn't get you anything, you need to take more risk, and taking that more risk gets money moving around in a sense, or gets certain things to happen that wouldn't happen normally, which again can be a bad or a good thing. I'm not going to get into Austrian business cycle theory right now. You can watch my other economics videos to understand that. This is more just so you can understand what the Fed's doing, why it does what it does. It can affect investment, okay? Most companies are always faced with the decision of what to invest in. Should they just make more of what they already sell, or should they invest in capacity, meaning the ability to make more when demand is high? For example, like and these are also in Austrian terms, these are referred to as long-term investments. So, for example, a long-term investment, or an investment in capacity, as Keynesians would put it, would be something like an extension on a restaurant, so that way there's more seating for the busy nights, or an extension to a factory, so that way they can build more stuff when they need to. Okay, always the fear here is if you have a recession after you finish these things, which again I'll refer to the Austrian business cycle theory, then what happens is that you've invested in something you don't need and you have all this unused stuff. Okay? While if you invested in inventory, sure, you have extra stuff, but all you can do is just, you can have a fire sale. So that's not necessarily the end of the world. But you can't really sell an extension to a restaurant on a fire sale. Okay, it can affect consumption. Okay, basically, if interest rates are zero, why are you going to put money in a savings account? You'll get a much better return out of going to buy a burger. So that's what you're going to do. You're going to go buy a burger. Okay, because the amount of return you get from the enjoyment that you get on eating that burger now is a lot better than the 0% interest that you're getting at the bank. Okay, especially since the money will probably be worth less tomorrow. So you'll be getting a negative return on putting your money in the bank. Okay, it affects asset prices. Okay, so the idea is if you think your money is going to be worth less tomorrow, then you're going to expect that asset prices are going to be worth more tomorrow. Okay, because again, prices of stuff and the value of money move opposites. Value of money goes down, prices of stuff go up. Especially assets. When I'm referring to assets, I say stocks, bonds, housing, stuff like that. International trade. Again, dollar devalues. Okay, or if they devalue the currency, that means other countries will be able to buy more of that currency, which means they'll be able to buy more goods from that country. So it can affect the flow of international trade, which can figure out, which can affect which businesses succeed and fail internationally. So you totally alter all sorts of different things. So basically, you're really altering the entire flow of the economy when you mess with the sums of money in large ways. Now, there's a lot of controversies regarding central banks. Okay, chiefly, should there be a central bank? Okay, you have people who are pro-central bank, who may enjoy the system the way it is now, or may want to reform it, which we'll talk about in the next 3 bullet points. And then there's people who want to get rid of the central bank, which fall into 2 categories. You have people who think that monetary policy and the amount of money should be driven by people in the government, okay, because they don't think the government should be basically have to borrow money. They rather the government print money, okay. I would not find myself in that camp. And then there's people who just think the free market can handle money, okay? And generally, this is the bank I'm in. I mean, again, I would be, but even this splits up into a lot of sub-camps. Federal Reserve Bank accountability. How do you hold it accountable? Should the Fed be more transparent? So again, auditing the Fed. So would that may help them make better decisions, the ways it's structured. So if you have rules, the rules may not always apply to what's going on in the economy. The problem is, if you have discretion and not rules, what happens is sometimes people can use their discretion to do things that are not necessarily in the best interest of the economy, but in their own personal best interests. So a lot of people favor rules because at least rules cannot be gamed or captured through corruption and stuff like that. And if the Federal Reserve does conduct rule-based policy, what should be its targets? Should it target inflation? Should it target GDP? Should it target productivity? What should it target? Okay, what is it shooting at? okay, and why should it shoot at it, and how much should it shoot at it, etc., etc., etc. So there's all these different discussions within, monetary policy, banking, etc. My name is Alex Merced from alexmerced.com. Visit those websites you see below, libertarian101.com, learneconomicsnow.com, and of course my website, alexmerced.com. Have a great day and enjoy.
My name is Gary Johnson, and I believe the Second Amendment means what it says. These men fought for your right to keep and bear arms. These men opposed it. So how about it, Mr. President? Which side of history do you want to be on? You swore an oath to uphold and defend the Constitution. Today, our Second Amendment rights are under threat. Do your duty to the American people or get out of the way. Be libertarian with me for one election. Together, we'll protect our Second Amendment rights, First Amendment rights, and all the other rights now being trampled by the people we elected to defend them. Live free.
In the last video, we had a little bit of a review of classical economics, and then we talked about how Keynesian thinking was a departure, especially, and why it might have made sense in the context of the Great Depression, where the economy was operating well below its potential. What I want to do, and it may be true any time that the economy is operating well below its potential, but what I want to talk about in this video is how Keynesian thinking can sometimes be dangerous. And one thing I do want to emphasize over the course of this video is Keynesian policies are often associated with people on the left, with policies on the left, Democrats in the United States. But the Republicans also are, for the most part, especially mainstream Republicans, especially the last several administrations, they have practiced what can only be described as Keynesian policies. When the economy started to recede, they tried to stimulate it by shifting aggregate demand to the right somehow. And we'll talk about that they tried to do it in a slightly different way through tax cuts instead of government increases, spending increases, but it was Keynesian in its underlying thinking. Now, just as a bit of a kind of backup, I'm going to talk a little bit more about that cycle that we talked about in the last video. So if you had person A, person B, person C, and person D, or maybe they're firms, and B supplies A supplies D, D supplies C, and C supplies B. And for the sake of simplicity, we said that they're all supplying 2 units of their good and service to each other. And let's just say that C has a bad dream, feels pessimistic, ate something bad, and all of a sudden isn't feeling good about the future and wants to buy less just out of caution. Maybe wants to hoard a little bit of cash just in case C needs it. And so he buys a little bit less from D. So he buys a little bit less than D, but D says, gee, my business is bad. Now I can't afford as many goods and services. Buys less from A does the same thing from B, and then B's business is bad, so buys less stuff from C, goods and services from C, and now C feels like they're psychic. But even though we see that it was actually a self-fulfilling prophecy, that C's pessimism actually led to that reality actually occurring. And in a worst case, it actually could get worse and worse. He could say, wow, I was pessimistic and I was right. My business actually did get bad. Maybe it even got worse. Maybe it got worse than C had expected. And then C could then say, well, I'm going to buy even less. Maybe I'm only going to buy a half from D. Maybe I'm only going to buy a half from D now. And then D says, maybe I'm only going to buy a half from A. And that cycle could go down and down and down until each of them are just buying exactly just what they need to get by, even though they all could be producing more. The economy could be producing more and could be wealthier, and they all could be way better off. And so this is, at least in my mind, a pretty good description of what happens in depressions, especially the Great Depression. And so there might be a rationale to say, hey, look, why doesn't the government come here at some point in this economy and stimulate demand? So why doesn't the government come here? So let's say B is already buying 1 from C. The government comes and says, hey, I'll buy another one. I'll buy another one from C. And then C says, hey, gee, things are good again. I can buy 2 from D. D could buy 2 from A. And then A can buy 2 from B. And then B can buy 2 from C. And so things have kind of gotten back to their potential state. The economy is revving. Now, in an ideal state, the government would say, hey, my work is done now. I can now take a step back. I could take a step back, and I don't want to overheat the economy. I don't want to push aggregate demand too far to the right and cause inflation. And so they will take a step back. Now, the danger here is that this is not so easy for governments to do. This was some type of stimulus, some type of government spending, although maybe it was a tax decrease, so maybe B could have increased their demand. But either way, once you do a policy like this, and let's say it was government spending, it's very hard to unwind. This government spending might have been for a project that some people like. It might have employed many, many people. Those people are voters. They're not just going to sit there while you cancel this government project. And so there's a risk that maybe there is a justification for Keynesian policy, but when it's time to undo that Keynesian policy, to undo that stimulus, it's very hard to do it. It's kind of a sticky policy. And so what you might have is when times are bad, you do Keynesian stimuli, but then when times are good, you're not willing to undo it. And if that Keynesian stimuli involves more and more deficit spending or more government spending, then the government size is just going to grow relative to the economy, or the deficit is just going to go relative to the economy, and you're never going to unwind it because the unwinding is unpopular. And I want to be clear that this is true of both the left and the right. In the stereotypical sense, the left might say, hey, let's do a Keynesian stimulus by spending more, so the government spends more, and let's hold our revenue constant, our tax revenue, let's hold it constant. And so obviously the government would have to borrow more money to fund this, or sometimes they might even increase taxes if they actually wanted to be more purist about it. But this is the variety that you see. And this would be a true stimulus. This is using the fiscal lever to put more demand in the economy. But on the right, you often see the other side. You see taxes being lowered, essentially saying instead of the government spending it, why don't we let people decide where to spend it, and they might spend it in a more efficient way. But it's going to be a stimulus because spending is held constant. And then you have the double where you do both sides of it, where you lower the taxes, you lower the inbound revenue, and you increase spending. And this is true. This has been done by both Republican and Democratic administrations, lowering taxes, but then going and starting a hugely expensive war. And obviously this will increase deficits. And there might even be a justification for doing any of these, a Keynesian justification, if the economy truly is operating well below its potential. The tough thing is it might be justified. You actually don't know exactly where that potential is, and you might not be able to unwind this once you get to your potential. Then you might overheat the economy, might lead to inflation, and that actually might undermine the productivity of the actual economy. The other negative of a Keynesian mindset is what happens over the long run. In the short run, this might make a lot of sense. Let's prime the pump. Let's get this cycle to happen in the right way again. But in the long run, it's essentially just trying to get people to consume and consume more. You'll often hear when the economy slows down a little bit, you'll hear the president, you'll hear politicians say, hey, we're just trying to get people to spend more through some combination of these Keynesian policies. We're going to lower taxes, we're going to increase spending. But they never say, you'll never hear them say, hey, we want people to save more so that we can invest more, so that in the classical sense, we can increase our total productive capacity. Now, the U.S. has kind of gotten a free pass on this because the U.S. has been doing essentially the deficit spending. It's been able to do the Keynesian stimuli, and that's why the U.S. consumer keeps spending more and more, saving less and less. The government is doing the same thing. But the U.S. has also been getting investment because it's the foreigners who've been saving and then plowing that money, and they've been essentially investing in the U.S. so that the U.S. could increase its productive capacity. But that is a risk for a country. If it's not blessed with that kind of free pass that the U.S. has gotten for the last several decades, is that when you have some resources, so in a given year you have some resources, let's say it's your time, you could either hunt and eat rabbits, or you could use those, or you could spend your time to invent new rabbit trapping devices. So this is kind of the hunting and eating the rabbits, and this is spending some time to go and figure out ways to be more productive at hunting rabbits, building some bow and arrows or something like this. You always have a trade-off between consumption and investment. And Keynesian policies, they're all about, hey, let's get consumption as high as possible. And that might be a good idea in the short run, especially if we are operating well below our potential, well below our full capacity utilization. But it could be a risk in the long run if you don't get the free pass, because you...
In 1913, the money power of the country was taken away from the people, but it was given up in the Federal Reserve Act. The Federal Reserve is no more federal than Federal Express.
You try a hide and destroy a freedom, man. You sick agenda. We know you anti-American. You come forward American Constitution. 1913, corrupt in the system. Devalue dollar, hyperinflation. The Federal Reserve, controlled by Lucifer. He can see you lying.